Hey guys, welcome to another Trade Genius podcast. Got my good friend Bob Kudla with me, and we are going to talk about why the last hurrah is finally here. Let's dive in.
Trade Genius.
Okay, Bob, why is this the big one and why is it here?
Yeah, so we're looking at right now with the market, the last chance for a blow off. But once that's over, Phil, maybe the euphoria from the election, but it sure as heck looks like Janet Yellen and the Federal Reserve and the banks forgot to get together, didn't read the memo, and looking at, if you bring that chart up, we're looking at basically the fuel, the elixir that drives the stock market higher is actually flatlining and falling, and we have a divergence between it and the stock market. Everybody knows, basically the Fed liquidity, bank liquidity, government liquidity is the fuel that drives the stock market higher. And it looks like in aggregate, it's falling, Phil. Not good news for the markets going forward. So unless they really decide to go all China on us or all Japanese 40 years ago on us, then I don't think they have enough oomph to keep the markets higher. The economy for that matter, too.
Yeah, so I think overall that's going to be the trend, right? I think we're going to see the reserves and the net liquidity come down, right? Net liquidity meaning the Fed's balance sheet, and then you take into account the Treasury General account, and then also the reverse repo window. Now, what if the reverse repo window goes away too? That throws another kink in all of this, and that's something that could happen that people aren't talking about because people are so accustomed now to this reverse repo window, right? Which is simply a facility that the Fed has to keep the banks liquid overnight, and that only shows up when they feel like there's a stress in the system that could affect banking liquidity, because that's what locked everything up in '08 and created like this big crisis where you were even wondering if the ATMs are going to be working on Monday. So whenever we have that reverse repo window open, regardless of what the Fed says or tells you, it's telling us that the Fed deems that there's too much stress in the system and they have to provide excess liquidity for those guys. So that how that sloshes around ends up in the market. So you have to factor that in while it's available. But if that goes away, that's another factor that could actually reduce the amount of liquidity in the system. So that's something that we need to keep an eye on. Now, if we're going to go into a recession, I kind of think they're going to keep that window open, and that's going to continue to provide liquidity or at least contribute to the ebb and flows of the liquidity as we move forward over the next 12 to 18 months. So what I think, Bob, might happen here is that because we've had this drawdown in the domestic net liquidity, we have global liquidity actually rising because other banks are throwing in the towel, right? China has capitulated. They've actually kicked off a round of QE. They're probably going to continue. But if you notice, the Asian markets were all down overnight. China was down. So I think what we're seeing is it's going to be one of those issues where they're throwing, and this is what happens when we start to cut rates into a late business cycle, is that it doesn't matter what measures you do, the economy is just going to start slowing because we've already thrown a lot of things at the markets to keep them propped up for the last 15 years. Those tricks are now spent. And now you're going to be basically you're going to be peeing into the wind now at this point, because the forces of the economy slowing down are too great. And you just can't jumpstart economies, especially late business cycle economies. You can't just jumpstart them by printing. It doesn't work that way. So the medicine's going to have to be taken. And I think it's just the sooner that we get that out of the way, the better. But I do think will happen though, Bob, is we will get a lift though in net liquidity, even domestically, as we go up into the end of the year. But I don't think it's going to get back to the levels that we previously saw. And I think we're going to go down. And I think we're going to have a repeat of 2022 where we saw a larger drawdown of net liquidity. And I think actually the Fed is planning the Fed is expecting that to happen, wants that to happen, because I think they want to firmly see core PCE in that 1% to 2% box that we've talked about. Because why? They'll be able to print later when this economy really is just stuck in the mud, when we're down in the throes of the bear market. Then they can do QE, because if we don't get core PCE down to those historical normal levels, then inflation is just going to be this monster that reignites very quickly and will be worse than it was before this all started.
Yeah, and we're going to talk about a little bit about that tomorrow. Are we going to get a collapse or a great rotation? Some really interesting takes. And I'm open to both. And the other thing too, Phil, late business cycle, the junkie has no more veins to pump in the dope. So
100%.
Time for the emergency room. We'll catch you guys tomorrow. Check us out, tradelikeagenius.com.
Trade Genius.